All right, everybody. Last week, all of the big banks reported earnings, and I'm going to try and go over a few of them this week. The first one I'm going to kick off with is BMO, just because BMO has quite possibly been the most volatile as of late. Its results have been the most sporadic. Over the last few quarters, a lot of people got concerned about the provisions for credit losses, how they were accelerating, but it looks like the bank reported a reasonably solid rebound quarter. The stock is up quite a bit since earnings, and I'm going to go over, discuss the quarter, and then later on in the week, I'll probably tackle one more bank. Let me know what bank you want me to tackle in the comments section below. And as always, everybody, like the video, subscribe to the channel, and if you want 3 opportunities I've researched for 2025, absolutely free. I'm going to drop a link in the description. As always, you will also get our weekly newsletter that I send out, market commentary, articles, case studies, all that kind of stuff. 25,000 other Canadian subscribers get it every single week. It is an outstanding newsletter, and it's going to help you become a better investor. So let's dig right into BMO's quarter, and the first thing I'm going to go over is their estimates relative to what was expected. So BMO reported a very good quarter. So we're looking at revenue of $9.26 billion versus expectations of around $8.59. But the one big thing here was earnings per share of $3.04 compared to expectations of $2.40. One of the main reasons for this is the fact that the Bank of Montreal has been reporting, at least historically, very high provisions for credit losses over the last 2 or 3 quarters, and the market was probably pricing in a lot higher provisions than the company actually reported, and it seems like it looks at least like the company might have gone a little over the top the last few quarters, or possibly their commercial real estate down in the United States. It's possibly normalized a bit. We've seen Equitable Bank have to report a gigantic increase in provisions for credit losses over a single quarter. So things like that can happen. It can spook the market, and ultimately it can cause, a big sell-off in a company that might have not otherwise deserved it. I personally sold BMO, I believe it was at the start of 2024. I didn't really like the way they were going with provisions. I ended up funneling most of that position to Royal Bank, which has done quite well. It's been a net gain for me overall, but I don't necessarily view the Bank of Montreal as a weak bank or anything. I actually do believe it's one of the better ones in Canada that just kind of went through a few issues. So let's dig into the quarter. We're looking at net income, adjusted net income, $2.3 billion. We're looking at adjusted earnings of $3.04. Like I said, we're looking at returns of equity of 11.3%. Overall, it was a fairly strong quarter. We look at Canadian personal banking. We're looking at revenue, $2.9 billion to $3.05 billion on a quarter-over-quarter basis. When we look year-over-year, we're looking at mid to high single-digit growth. The one thing that has stalled out a bit, and again is going to be the main commentary I talk about in this video, is the fact that BMO's U.S. segment is not doing very well at all. We're looking at $1.83 billion in the fourth quarter of 2020, or in the first quarter of 2024, to $1.87 billion in the first quarter of 2025. So we're looking at pre-tax, pre-provision income in the Canadian segment. That's growing 13% year over year, whereas the U.S. segment is growing 6%. So there's definitely some difficulties there, and this wasn't always the case, but it's kind of having a lot of pressure in terms of, like I said, provisions and just overall slowing growth in the United States. There's a lot more competition there. It's overall not been a very good, I would say, 2 years for that company's, for that segment for the company. BMO Wealth Management, we're looking at huge growth, double-digit growth in revenue, capital markets, double-digit growth. We're looking at pre-tax, pre-provision income of 48% growth, 67% in the BMO capital markets. When we think about this, the stock markets are booming. The equity markets are going crazy right now. The markets are very popular. And when stuff like this happens, obviously you're going to get large increases to capital markets and wealth management. The one thing you need to know is that this is probably going to be cyclical. It's going to vary. In 2022, a lot of the capital market segments from the banks struggled. So you're probably going to see this growth normalize over a longer period of time. For the quarter across the entire business, we're looking at revenue growth of 18% on a year-over-year basis, 11% on a quarter-over-quarter basis. We're seeing expenses rise 9 and 7%. We're looking at pre-tax, pre-provision income of 32% growth year-over-year, and we're looking at 16% growth quarter-over-quarter. So when you think about it, I mean, look at the decline in provisions for credit losses. We're looking at a quarter-over-quarter decline of $512 million, and we're looking at a year-over-year increase of $384 million. So the year-over-year increase is still not that good, but this quarter-over-quarter decline is a really strong sign that something has normalized in this department. I mean, the one thing about it is the company is still reporting fairly high provisions for credit losses. I mean, they're not doing as well as a company like, say, Royal Bank or a company like CIBC. And again, I think that is due to that U.S. exposure, especially commercial real estate. That's been hitting them pretty hard. I mean, when we look to diluted earnings, we're looking at a 48-cent increase year over year. So again, we're looking at, double-digit growth in earnings, return on equity. Starting to see an improvement in return on equity here, 11.3%, 70 basis point boost year over year, and a 390 basis point boost quarter over quarter. And CET1, well above regulations, 80 basis point increase year over year, so it's healthy in that regard. Now, the one thing I do find a lot of people state about these banks, especially in regards to the provisions, is the fact that, it's just money they're setting aside just in case. And the thing is, their PCLs on impaired loans came in at $855 million, or 50 basis points, and the provisions on performing loans were only $152. Impaired loans are loans that have somehow already defaulted at some point. They're not necessarily written off. The bank doesn't think they're complete losses. But these are loans that have gone through some sort of payment difficulty, whereas the performing loans are kind of loans that the bank has set aside and said, okay, these, they have a good chance of going unpaid or getting into some sort of default trouble, but they haven't yet. So for quite a while, it was performing loans that were the ones that were seeing the large increases, and this was especially apparent during the higher rate environment. So the banks didn't have a really good idea of where the interest rate environment was going. Rising rates were causing a lot of them, say they have negative amortization loans, or they have a lot of people that they feel, are pushing the limits in terms of what they can afford in that rising rate environment. You might see performing loans rise during that time, whereas now, they have a better idea of overall their credit situation, their credit quality. So a lot of these loans are in the impaired, in the actual defaulted segment of the PCLs, and fewer are in performing. So if you have the idea that a lot of these provisions are just set aside just in case, when the vast majority of them are that big in the impaired section, it's not as bright of a future, I guess you could say, as if a bulk of them were in performing and maybe the environment started to improve. So it's really important you understand the differences between those two types of PCLs. So when we look to the Canadian end of the business, on a adjusted basis, we're looking at year-over-year growth of 10%. We're looking at expenses have grown by 7%. Pre-tax, pre-provision earnings are up 13% year over year, and total provisions for credit losses in the Canadian arm of the business has kind of stabilized to the point where they reported a $36 million decrease in quarter-over-quarter provision. So this is definitely a good sign, but when I go over the U.S. segment of the business, you're going to see where the bulk of the provisions came from. So the Canadian end of the business is not really doing all that bad. It never really has been doing all that bad. We look to returns on equity. It's 21.3%. We're looking at efficiency ratios of 42%. Their Canadian end of the business is very strong. We're looking at loans up 6%. We're looking at deposits up 9%. Overall, the Canadian end of the business is doing very well. There's never been all that much of a question in regards to BMO on the Canadian end, but when we come down to the U.S. end, this is where we start to really see the bank's struggles. We're looking at revenue of 2%. We're looking at pre-tax, pre-provision earnings. They're up 6%. Here's the big thing here. We're looking at provisions for credit losses, $287 million, which is a $222 million decline quarter over quarter. Yes, it is a year-over-year increase of $70 million, but the one thing about these banks, the quarter over quarter provisions is going to give you a much better idea of just the overall environment. We're looking at a efficiency ratio of 54%, so not as good as the Canadian end of the business. Ultimately, you want to see a lower efficiency ratio. It effectively looks to the bank's operating expenses and compares them to revenue. So you want a bank with a lower efficiency ratio. So we can see up here, we're looking at 42% and we're looking at 54%. So when we look to returns on equity, we're looking at 7% versus 21% in the Canadian end. So the U.S. end of the business is struggling. There's no doubt. When we look to net interest income, it's flat. When we look to net interest margins, they're down year over year. They're up quarter over quarter. Again, when we look to the overall makeup of the provisions for credit losses, $287 million. Impaired are $217 million. Performing $70 million. Average loans and acceptances are actually down 1% year over year. So when we look up here, we're looking at, the Canadian end of the business is up 6% year over year, where we're seeing down 1% year over year. Deposits are relatively strong in the States, up 5% year over year, but the thing is, in Canada, they're up 9% year over year. So the Canadian end of the business is performing very well. I mean, the wealth management and the capital markets, I'm not going to go over too much. Just know that, these parts of the business are reporting significant, very strong results, especially when we look to the insurance arm of their wealth management. I mean, year over year adjusted revenue up 64%. It's a fairly small segment of the business, but overall, these are areas that are going to do very, very well when the markets are doing well. I mean, we look to global markets on their capital market end. We're looking at year over year increases of 43%. Obviously, that's done quite well. So when we look to the overall provisions for credit losses, when we look to the PCL ratio, which is effectively the provisions for credit losses relative to their loans. So a slight uptick, we're looking at 38 basis points first quarter last year, 44, 54. Then we see that big jump to 91, and now it's down quite a bit again, down to 58, because they reported such a big decline. So when we come to provisions for impaired loans, as we can tell, as I mentioned last time, we're looking at a big jump in business and government. So that would be, commercial loans. We're going from 518 million to nearly 800 million in a single quarter. But now that has gone down. We're looking at a big recovery, 795 million down to 492, which is actually lower than it was in the third quarter of 2024. So there is some pretty strong signs there. We looked at provisions overall. As I had mentioned, we started to see it creeping up significantly, and they don't have 2023 on here, but it started to creep up in 2023 as well, which is ultimately when I ended up selling my shares. But we're looking at 627, 705, 906, and then we report this big blowout quarter of 1.5 billion. But now it's starting to come down, and I do believe that's why the bank, first off, blew through earnings expectations, did so well, and secondly, is doing well stock price-wise now because, the market probably think this is a little more normalized and it's not going to be as bad as people thought. I mean, if you do this 906, then you do 1.5 billion, then you come out with like a quarter of 2 billion. The stock price would have taken an absolute beating, no doubt. If we come down to the gross impaired loans, when we look to actually what is hitting the company right now, I mean, we're seeing service industries, 481 million in formations. We're looking at manufacturing, 284, commercial real estate, 296, the bulk of it, which is in the United States. But we're still seeing some weakness among, areas that I would say are impacted by, small to medium-sized businesses, especially service industries, and just overall, I would say they're not out of the woods yet, but it was a pretty good quarter overall from BMO. I mean, we're seeing, investors who bought back in August when, people were very, very bearish on the bank have done quite well. I tend to not really worry about these types of movements overall. A lot of stocks will do this. I mean, if you look to the, 3-year chart of BMO, it has really struggled over the last while. Now, whether or not the environment continues to improve and they become a better performing bank, ultimately, I think that's possible. They are a high quality institution. Would I buy it right now? Probably not. I, first off, have just reduced the amount of banks I own, period. I own 2 banks, National and Royal, and I guess you could add Equitable Bank in there. They're fairly small positions for me. I don't plan to add any of the other ones unless the environment shifts quite a bit. Ultimately, I do feel a lot of Canadians are very, very heavy in Canadian bank stocks. I personally know some people who Canadian banks make up 25-30% of their portfolios, which ultimately it's completely up to you as to what you want to do with your portfolio. But for me, I try to keep it anywhere from 6 to 7% max. And if they do get any bigger, I tend to trim them. I don't plan to add BMO. I do believe that Royal and National are performing a little bit better right now. Will be a little bit better long-term holds, but there's no doubt if you bought it back in August, you're doing quite well. Congratulations. That's it for the video, everybody. Head down below, like the video, subscribe to the channel, comment down below. Let me know what bank you want me to go over next. I'll be doing the bank that has the most comments. And as always, 3 stocks that I really like in the description below. You can sign up for that, and you'll also get our weekly newsletter, which goes over case studies, market commentary, all that type of stuff. It's an amazing newsletter. 25,000 people get it every single week, and you'll want to become part of that list. So everybody, we'll see you next time for more great Canadian content.